Hello, everyone. Welcome to today's podcast with ARG Investments LLC. My name is Avin Savani. Today, I'm going to be talking about operational risk management in commercial real estate and also operational flow, and something that I suggest any startup company that is planning to become a real estate investment shop should kind of define right off the bat. So this is like kind of a quick tool that I always use. I keep it on my desk, even on like a bulletin board, as you can see in the back. So it's a really useful kind of thing to just brainstorm, and it just keeps good deal flow and keeps you in that right mindset when it comes to being active in the commercial real estate space. So yeah, one thing that I always look for is good team development. So within any type of real estate investment shop, you should have all the teams defined out. So whether that's your acquisition department, your capital market department, or debt research, or someone who is handling most of the lender relations, or your asset management and property management team that is actually operating, maintaining, and keeping the assets up to par with the competitive environment. So I'm just going to be sharing with you my kind of rubric that I use. And I also, if you guys want to use this as well, feel free to copy it and share it with your friends and family as well. So yeah, let me share my screen real quick so you guys can see this. So the first thing that I'm going to be talking about is just your operational flow. So like I mentioned, the acquisitions and the underwriters mainly responsible for great broker lender deal flow and communicating with them on a consistent basis week in and week out. So either you're researching through either your off-market listing platform or your on-market, whether that's through brokerage sites or a platform like LoopNet, Crexi, and just seeing if there is something that matches your criteria. So that's another thing that I highly suggest is defining your criteria, the asset class that you're looking to invest in, whether that's multifamily, industrial, office, retail, you name it, and making sure that you also have the alternative sectors within that nailed down as well. So within the multifamily sector, for instance, there's student housing, affordable housing, and conventional market rate apartment buildings. With that, there's definitely different strategies, short-term, mid-term, long-term. There's also the BRRRR strategy, which is very popular. Many people use that. And it also just depends on the hold period that you have or what you underwrote for that property. So if you're realizing the better return on investment in year 5, holding it 5 years, and then just going through the disposition process, that's the best scenario. So within an underwriting model, you should have some type of IRR breakdown and make sure that it's partitioned on an unlevered or a levered basis, and you can see it year by year. So you can ideally time out which year is the best time to sell. And that also just depends on feel within the market as well. I'm highly I highly suggest that you it depends on the time in the market, not the timing of the market. So highly suggest when you feel that it's right to dispose of your asset and you feel like the market is the right time to sell it, then it's the best time to go with that process. But yeah, it just depends on your underwriting. I have a kind of breakdown as far as like year by year IRR, equity multiple, as well as the overall profits that you're going to be generating throughout that the life of the asset. So yeah, that's kind of a quick breakdown of that. But basically, you're going to be acquisition underwriters always perform market and sector research. So when you're defining a development project or an acquisition, you're mainly focused on the demographics, seeing if there's population growth, job growth, good affordability, easy landlord-tenant laws, making sure that, like, let's say the eviction process is very smooth. There's minimum rent control, basically landlord-friendly states, I would suggest to start off. And then also making sure that your site has good visibility. It has easy access to transportation. It's surrounded by complementary development where not only that property is projected to appreciate in the next 4 or 5 years, but also there's a good vibrancy of economies of scale. So whether that's a life science sector, medical space, office and retail in that area, and also just basically a strong, fundamentally sound economy. So that's what I look for when I'm looking at a area. And you could also base it off of just the yield that you get in that particular area. So whenever I'm underwriting deals, I keep like a sub spreadsheet where I can track the yield on cost in that particular sub market or that main market. And I just compare that to that market cap rate wherever it is, and I just keep that. So for instance, this is a popular source that I've been using, and it's a company that I've followed for a while now. It's called Lone Star Capital. They're more active in the Dallas region, so if you're very interested in their projects, feel free to check them out. But they provided this quick multifamily deal tracker, which is extremely useful. I highly recommend it. But you can pretty much just, whenever you're underwriting this, I consider this preliminary underwriting. So you're basically putting in the basic investment highlights of the deal, such as like price per square foot, the square footage on the property, the year built, the number of units. And then you're also just taking a look at what the guidance is from the seller side broker and what you think that broker's value should be. So this is just a quick, easy way to do it. And I'm probably gonna have to blur out some of these names and everything, but this is just a way to go about it. And you can see here that I track it as far as the underwritten cap rate, the yield on cost, and then the underwritten cap rate from the seller, and then the market cap rate in that area. So within any market, I can see like what the spreads are and which area is yielding the best results. So basically, a good tactic that I use is that whatever the seller's underwritten cap rate is, and then comparing that to that market cap rate. And yes, albeit market cap rates change. It's not the most stable thing to look at, but it's a good baseline to compare to the seller's underwritten cap rate. And you can see around about what their entry cap rate with that deal was and their exit cap rate, seeing the spread between that, dividing that by or finding the rate of change with those two numbers, dividing it by the hold period, and seeing how much NOI has been growing year by year. So quick example that I always give is from a 5% to a 5.5% cap rate expansion over a 5-year hold period is basically growing NOI by 2% per year. So that's a good thing to look at. And then you can justify that to the OM's stabilized NOI and then the current NOI that is from their financials, and seeing if maybe the NOI is not really feasible in like that growth period. So sometimes I've seen like 15% NOI growth rates per year, 20% NOI growth rates per year, and that's just not reasonable. I think NOI has subject to grow like maybe maximum like 10% per year. But it's rarely that you see that NOI grows beyond that number, and it's just not practical in my opinion. But that's just my take on it. And then obviously with a value add investor, you're defining your CapEx budget. So when you're doing just this preliminary underwriting, I think it's important to just see off the OM's picture, like what types of pictures are there, what quality, what style of quality is those units, and do you think that you might need some extra CapEx? And you can justify this with some basic property condition questions that you can ask with the broker. But those are just some things that I think you should just define right off the bat. Sometimes I budget roughly like $4 to $6 per square foot. Other times, if there is some major CapEx, like let's say all of the HVAC systems need to get replaced, the roof needs to get replaced, there's some major electrical or plumbing issues, the exterior driveway needs to get like repatched and resurfaced. So there might be some additional costs there. So you should definitely budget for that. And I think it's also wise to, while you're simultaneously doing this, communicate with the property management companies to justify some of those costs. So it's always great to ask them that, hey, what are some rough quotes that you guys get for a full-on roof replacement, right? For like a medium-sized multifamily asset. What is like the average price to replace an HVAC unit, right? So just ask those quick questions and you can gain some insights to help justify your CapEx budget. But yeah, and then the other thing that I just wanted to build on. So with this operational plan, pretty much you're tracking day-to-day operations. So I always keep like a goal kind of tab, like whether it's just like on like a little sticky note or something, but weekly, I just like to stay up to date with the properties that are on either listing platforms, on and off market platforms. And there's a lot of great sources out there, but some free ones that obviously I use, Crexi. LoopNet is not the most friendly environment, but it still has some decent deals. And then also the major brokerage platforms as well. So those are just some areas where I can find. And then if you are planning to kind of run your operations and invest in more data and more off-market platforms, obviously like PropStream, Batch Leads, there's a lot of other great ones out there. And also Reonomy is another great one. So there's some great ones that I suggest that you research. And when you come time to building out your team and you're growing with your team, then it's time to invest in that data and technology. But yeah, if you're kind of a small scale or medium-sized scale investor like me, and you're just looking to just learn and prepare for yourself to get into operating and managing a larger team, then it's wise to just rely on just the brokerage platforms and the free market platforms that are out there. But yeah, and then with the acquisition underwriters, obviously when you get to the point where you're ready to close on the deal, you're under contract and you're going through that phase, it's great to have an architectural and engineering plan defined out. And I made a video on this where just going through the entire design development process within any type of renovation or rehab project. I think I made that maybe a few months back, but highly recommend take a look at that and see where you can gain some insights. But the other thing is obviously with financial feasibility and development budgeting. So when it comes time where you're past that stage of bringing in JV partners and you're ready to kind of launch your own syndication, fully registered SEC registered syndication, and you have limited partners, you're putting together investor presentations and pitch decks, and you're really putting your effort into making sure that this process is thoroughly screened and it's also you've vetted that entire process. Then it's wise to really start to implement some good data and technology where you can have like a good market report, either like a CoStar report or a Yardi Matrix report, and you can explain to them why this asset in this area is a wise investment. And also with that, it's wise to invest into a investment management software such as like an Appfolio, which has their investment management software. There's a bunch of other ones. Juniper Square is another one. But that's the time to invest there because that's where you can upload all of your legal docs, like your PPM, your subscription agreement, your operating agreement, limited partnership agreement. And you can also upload all necessary docs into the Dropbox so that they can view that and be sure that it's the best investment that they can make with their money. So when it comes time to that, their money is the utmost important. You have to manage it properly and with due diligence. So I highly recommend that to stay organized to invest into that. But yeah, and then other operational responsibilities, obviously, with the closing process and due diligence. Many aspects within due diligence, obviously, from starting from the underwriting to the negotiation phase, to the title report that you need to do, the insurance quotes that you need to get, the debt matrix that you need to obtain from your lender. And it's a lot of back and forth work and third-party communication. But I think it's great that you invest into a CRM where you can effectively kind of manage all of those conversations. And also when it comes time to kind of operating deal flow on a more consistent basis, then another software, I keep giving plugs, but another great software is TermSheet, where you can upload your underwriting and also effectively track all the different due diligence items that you need to accomplish within the deal. But yeah, and then the other thing, obviously, it's great to invest into a professional accounting team when you're scaling with your business. You have more units and assets under management. Scaling with the team, having a professional accounting team and a CPA handle all of your financials is very important. And the other thing is obviously with the software setup and clear transactional flow, I already mentioned that, but the other thing is tax prep and CPA meetings. So whether you're planning to cost seg that property and realize the maximum depreciation write-off with that property, then it's a wise thing to perform a cost seg study. Now, I'm not a CPA, I can't give any advice on that, so that's a disclaimer, but that's just something to be mindful about, because you want to realize the most tax savings within any given deal. And then the other thing with attorney meetings, obviously, during the legal entitlement insurance phase, making sure that your LOIs and your purchase and sale agreements are run by the attorney and making sure that the language and everything is proper. I think that's a wise thing to do. And other than that, I think when you're also in a syndication mindset and you're performing a syndication, that's another thing, and a lot of legwork that you have to go through with your attorney to make sure all of those contracts and agreements sent to the limited partners are accurate and they're well, like, kind of spelled out. So yeah, and then that's that. And for the asset managers, obviously, this is working hand in hand with property managers and managing the managers, essentially, you know. So pretty much they're supporting the acquisitions team during the due diligence phase. So there's a lot of different documents that the acquisitions guys have to pass off to the asset managers, such as all of the seller docs, the historical financials, the maintenance logs, the utility logs, and so many different items that need to get passed over, like aged receivables, concession reports. The list goes on and on. But I think it's great to make sure that they're communicating weekly with the acquisitions guys when they, especially under contract, pretty much daily, making sure that those documents are communicated well and they're ready to go and operate the property. So the lease up phase is one of the most challenging aspects in commercial real estate, I think, and reaching stabilization is one huge goal. And within any type of project or like ground up development or acquisitions, proper marketing and making sure that you're reaching out, generating leads. You're on pretty much every listing platform, Zillow, Redfin, Realtor.com, or sorry, not that's for residential. I meant apartments.com, HotPads, or any other rent site. That's a wise thing to do. And also lease review is huge. So with any lease, it's very important that you define out all the lease terms, the commencement date, the expiration date, the option period, the rent escalation that you have, rent growth, obviously, and also defining out if there is common area maintenance that you have to pay, or ratio utility billing service that is getting reimbursed back to the landlord. So all of those items should be done through the lease review, and those should also be ran by your attorney again. And also other documents within that are the tenant estoppels, basically a reminder to tenants, just a general kind of like lease abstract, just going through the main terms and reminding them what the terms are with the lease. And also SNDAs as well, subordination non-disturbance agreements are necessary. So yeah, and then major aspect of asset management, huge aspect, I really think, construction management. So this is probably the most risk I would say that is involved is construction management. There's different types of relationships within the construction industry, whether that's with developers, with construction managers, with the actual general contractors, different ways to go about it. One thing that I've learned, and maybe you guys have heard this, but the DBOM strategy, which stands for design, build, operate, maintain, it encompasses construction management at agency. So I think that's the best way to go about it, where you have a construction management team within your agency, and you're not at risk of, let's say, all of the subcontractors are a team with the actual general contractor, and it's not actually researching the actual market, finding the best subcontractors that are out there with your team. So the best interests within the DBOM strategy and the at agency construction management at agency is that the investor developers' interests are at the forefront. So I highly suggest that's kind of like the way that I envision it. And those subcontractors would have direct contractors with direct contracts with the investor developer, and the construction management team, whether that's a project manager, the actual construction manager who's supervising the general contractor, or also just researching that market and finding the best subcontractors to handle the renovation process. So that's I would say that's the easiest way to go about it. And with that, you also have to handle like the construction draw schedules, communicating with your lender, knowing how much is getting dispersed out to you within that period, and making sure that you're submitting to the lender the accurate quotes and the invoices from those contractors. So that's that. And then tracking budgeted versus actual is a huge aspect too. So seeing where your buffer is at within each trade of business is a wise thing to do. So pre-construction is, I don't want to like put too much insights into this because it's not my like expertise, but with pre-construction, pretty much just walking with the contractor, going to the site, addressing the plan, like the monthly and the actual the year on plan, however long it's going to take, and just addressing each and every aspect from ground up, from the foundation to ground up, that is going to be encompassed, and addressing obviously the price, quality, and speed is a huge aspect too, because you have your limited window to complete your renovation project. And if you go over that window, and let's say you have some bridge debt on that project, and it's expiring in a few weeks, like a few months or something, and you need to refi out into something else, it gets kind of tricky in that situation. So really having a well mapped out kind of Gantt chart, I would say, basically a month by month plan of what you guys like want to accomplish, and also the draws that are going to be given to the contractors is really a good thing to go through. And obviously the scope of work is going to be defined through all of those different aspects, from building the skeleton to the MEP work that is inside, and then also just finishing touches on the project, such as the furnishing, the furnitures, fixtures, and equipments, essentially. So yeah, and the other thing asset managers should be doing, obviously, is financial meetings with the acquisition and accounting team, just going over monthly, quarterly, annual reporting, and also providing some portfolio analytics. I think that's a good bonus if they can do that. So if you have a syndication company and you're running syndications with limited partners, then providing these monthly, quarterly, annual reports along with the portfolio analytics is a wise thing to do to keep them informed about how the project is performing. And then lastly, marketing strategies, obviously with the software setup, your web development team, your social media accounts, your campaigns and events, and also scheduling some webinars to keep posted about the deal. That's all kind of encompassing the marketing. So yeah, and then obviously I forgot the investor pitch decks, reviewing that with the acquisitions team, because they're going to also provide a lot of good insights and key elements that should be reviewed in preparation for that setup. So yeah, and then recruiting and training can also go through this team as well. If there is like a talent acquisition team with your company, that's a huge bonus, and having a recruiting team is definitely needed and very valuable. So yeah. And now this is the risks that I wanted to get to. So with any type of investment, there's a bunch of risk, but I've kind of narrowed it down to these quadrants, and thankful for kind of communicating with a lot of insurance people in the industry and seeing how they go about operational risk within CRE. So yeah, first off, obviously macroeconomic risk, being comfortable with your target market, performing the necessary research, all the things that I just mentioned initially, and that's something to initially do. And given this uncertainty in the market, volatile capital markets, and just like kind of a stagnant flow or stagnant deal flow really between investors, brokers, and lenders, it's kind of a murky situation right now. But I think the people that are most confident in their market, they've done their research, and they're well prepared to take on different assets that are about to trade and come to market. I think those people are definitely going to outperform, and especially if they have their teams defined out and all the roles and responsibilities within that, they're definitely going to be performing the best, in my opinion. So market research is a huge aspect within any industry. So performing that right off the bat is critical. So yeah. Now, property condition risk is another thing. So along the risk spectrum in commercial real estate, you have 4 different types. So you have opportunistic, which I think is like C minus, C plus, or in the C range, really. Aspects where like you're gonna have to go through a bunch of rehab and renovation, or maybe even a pretty much a whole gut out of the entire property, just basing it off of the distress levels, and just going in, pretty much creating a brand new product, essentially. That's what I think opportunistic is. And with that, there are some different styles of projects. There's qualified opportunity zones. There's tax abatement projects where you can go in and realize a good tax abatement for a good period of time. So there is some incentive with more difficult projects to take on, but I think opportunistic is a different taste for investors. And if you are very active in the construction industry, I think it's something that you may have the capability to take on. So that's the opportunistic spectrum. Value add is either C, it could range from like C plus all the way up to B plus, in my opinion. So value add is very up in the air. There's heavy value add, medium, light value add, right? So with that, you're just addressing the major CapEx items, any deferred maintenance with the project. With these types of investments, they've performed well, like over their life cycle. They've had decent property management companies come in and out of the product, and they're also just maybe struggling just initially with like their rents, with their operational plan. Maybe they haven't invested into the best software to track everything and keep good communications. So with a value add plan, you're really focused on your operational property management plan, and making sure that you've done all your due diligence, you've done your lease review, you have good marketing. You may even have some licensed brokers with your team to have that marketing capability. And you also have a great software system that you use, like maybe a Buildium, Appfolio, Rent Manager. List goes on and on. But yeah, so that's the goal with a value add plan, is you're going in there to realize initial value and address initial value. So some things that people that come into a project thinking is, how do I improve the utilities in this project, right? So maybe like they don't have the best RUBS program in place, so investing in a software for that. Or maybe they haven't raised the rents in a while, so adjusting those leases and negotiating with tenants on their leases would be a wise thing to do. So these are main action points that need to be taken within any type of product. Or maybe like the operating expenses on that product are way off the bat, so it's like a 60% operating expense ratio, and you need to get it down to like 30%, so there's aspects within that where you might have some initial CapEx budget and you may need to spend a little bit in year one, but the amount of value that you've created is going to be lasting for like the next 5 or 6 years, or however long you plan to hold it. So that's the main goal with value add. And now pre-stabilization. So I would you could say pre-stabilization or core plus. So this is essentially like a B plus, closer to an A minus type product, where you're really just focusing on your lease up and making sure that you're getting to stabilization, whether that's reaching a goal of, let's say, 95% occupancy or 97, or however ambitious your goal for occupancy is. And also just making sure that you have great tenant relations and communications with them, so that they have a comfortable place to live. They like the environment. They feel a sense of community, and there's definitely some outlook and potential for them to renew those leases in the near future. So that's pre-stabilization. Core is obviously getting towards the luxury style products, like A plus style products, where it's really highly amenitized. There's a bunch of different items within the facility. There's a pool, there's a spa, there's a gym, there's lounges. There's really a more luxury style lifestyle for high income earners. And that's a different taste. And obviously with that, it's more emphasis on interior design, and bringing a product that definitely puts emphasis on the interiors and the exteriors for that project. So yeah, it's definitely a different style, but if you're a person that likes to invest into those luxury style assets, it might be something applicable. So yeah, and then making sure that also you have like an established inspector come in, address all of the items that need to get addressed, such as interiors, exteriors, structural issues, HVAC, roof, electrical, plumbing issues, hazardous substances, list goes on and on. But yeah, making sure that you have a good, trustworthy inspector come in and draft that PCA, property condition assessment, is really important. And you can also, after that, negotiate for some seller credits that could, if the seller is willing, obviously, but that's something to use as a negotiation technique. But yeah, and then obviously with the LOIs and the PSAs, they should have the contingency periods specified and laid out. So whether that's like a month-long inspection period, a month-long, like maybe like title review and insurance and debt kind of structuring for that product. So different periods that you need to define. And if there is some issues that come back with those items, like let's say there's some clouds on the title, there's some issues with the title report, then there is that ability for the buyer to back out of that contract and retain their earnest money deposit. So now, obviously, there are some instances where earnest money deposits go hard. So I can't really speak too much on this because Every type of contract is spelled out differently. But I do think that, and just taking like that broker's perspective, a person that is committed to the deal, regardless of some instances that may pop up, and they have their earnest money deposit go hard, right? And they're in that period where they pretty much locked into that project, and they're willing to go out for it. That's an offer that kind of stands out. So definitely, I definitely think it's wise to be mindful about the contingency periods and not have too much, because that can be an unattractive offer for the seller. So yeah, and that's property conditions. So now getting to the capital stack. So I always suggest start with the debt, address the debt first, and then get to the equity portion of your project. So the debt is the most the highest risk, I think, in commercial real estate. So making sure that you structure the appropriate debt with the business plan, and also keeping good communications with your lender or your mortgage broker who is shopping around for the best debt, is a wise thing to do. So when you're under contract and you're going through that period with your debt team, it's great to just see what the options out there are. And with a value add investment, it's great to either structure some bridge debt or some short-term debt initially. And if it is floating rate debt, making sure that you're buying those interest rate caps to mitigate your upside risk is really key. And with that, obviously some lenders could go with LTC loans, loan to cost, that is. So they include your entire CapEx budget into the valuation of the project. And with that, you need to justify your CapEx budget and make sure that you've gotten all of the rough quotes from the third parties that are going to be performing those trades. But yeah, and then also keeping good documentation is key. So initially giving them some type of company presentation or investment strategy presentation, and then also making sure that you're complying with all of their documents, such as W-2s or tax returns for corporate tax returns, financial statements, underwriting for the project, and all the different quotes that you got, insurance quotes, and tax quotes as well. So those are some items to just keep mind for, because they're going to be handling that lender reserve account, and they're going to be making sure that you're keeping those reserves, so you have the ability to pay for it after pretty much everything is netted out. So yeah, and then if you are raising some equity, if you're doing a joint venture deal or syndication deal, transparency with your investors is very key. So I think that if you know your deal in and out the most, and you're the most knowledgeable about your deal, and you're very passionate about explaining your deal, I think that is evident, and I think they'll be attracted to that for sure. And I think just making sure that you're staying professional with all of your documents, and having like I mentioned, the investment management software is very important. So yeah, and these were just some items that should be included into any type of Dropbox or kind of deal room for the investors. This is what I think should be included. So oh yeah, so that's another thing I forgot to mention. So if this is going to be a podcast, people are not going to be able to see what I'm kind of going through. So I'll just talk this out. So you have your investment presentation, you have your property financials and your underwriting model, your final like justified underwriting model. You have your debt term sheet and Excel matrix that you got from your lender. You have your insurance quotes. You have your property tax calculations done with your property tax consultant. You have your cost segregation estimate and a bonus depreciation info with your CPA. You have market research and a data analytics report, either from a professional technology company like CoStar or Yardi, or if you made that market research presentation in-house, you can also present that. You have your legal docs, obviously, the private placement memorandum, the subscription agreement, limited partnership agreement, and the operating agreement and wiring instructions for the limited partners. So yeah, that's kind of the gist of what a good investment management software should have in a deal, and just also holding like the marketing aspect, holding webinars, including them into the actual deal, and being very personal about it is very important. So yeah, and then lastly, the last risk I think is the operational and execution risk. So scheduling bi-weekly calls with your property managers if you are doing third party, checking in on the main key performance indicators. Oops, sorry. Addressing all the maintenance issues, handling good tenant relationships. Those are all aspects of a good operational and execution plan. And then also having the PM software kind of vetted out and all of the different documents uploaded into that is very important too. And also, like I mentioned, construction management is a vital aspect of it. Having your pre-con and your clear scope of work defined out in your scheduling is very important. And yeah, and then other great asset management duties, like I mentioned before, is handling the refi period, when the best time to do that would be. So seeing where interest rates are, keeping a good pulse on the mortgage markets is very important. And also auditing those financial statements, making sure that they're ready to get submitted to your CPA to perform the tax returns is a whole other aspect. If you have a professional accounting team, that's the best thing to do, in my opinion. And communicating with them and providing those audited financial statements with those well-defined line items, so it's easier for the CPA to perform his tax return is very important too. So yeah, and then obviously coordinating a disposition is another huge skill to have. So having a good broker who knows how to sell your asset in the best light possible is very critical. So that's just a quick, I know it's a lot of things and this list literally could just go on and on, but those are just some things that I kind of look at when from the start of evaluating the deal to when you're actually under contract and then when you're actually operating and managing the project. And I think with any project or investment, I think it's very good to have or start with a good foundation in your underwriting model. And that's kind of like the bird's eye view that I think. And it starts pretty much every single relationship that you have in this industry. So whether that's obtaining like your insurance quotes, your debt quotes with your lender, communicating with your broker about the actual deal, what works, what doesn't work, what your yield on cost is, are you realizing some type of spread there? So there's many aspects within that start or kind of kickstart a lot of conversations within the industry. So if you're looking to kind of just get started in the industry, I suggest just researching a few deals, signing some confidentiality agreements, and keeping posted with some brokers in your market. I think that's the best way to start. And I think the conversation that you have and asking also the right questions is the best way to go about it. So hopefully this video was helpful and people got some good insights into commercial real estate. And if you have any questions, you can also network with me. My door is open. So my name's Avin Savani again. Also, you can reach me at our company email, which is argllc10@gmail.com. And you can also reach me via YouTube or just communicate me via LinkedIn as well. So very active on those platforms. So feel free to connect. And thanks again for watching. And feel free to like, comment, share, subscribe, and have a great day.